You're listening to the Decisive Podcast, insights and analysis to empower confident decision making.
Hello, welcome to the latest episode of the Decisive Podcast from S&P Global Market Intelligence. I'm Paul Smith, a senior economist at S&P, and today I'm joined by two other senior economists to take you through some of the most recent findings from the closely watched Purchasing Managers Indices. So firstly, it's a good afternoon to you, Phil Smith.
Good afternoon, Paul. Yeah, good to be back. Yeah, looking forward to discussing some of the key going on in the Eurozone. The particular focus on Germany, where there's some really interesting developments in recent months.
Thanks, Phil. All sounds very good. And we also have Andrew Harker here today as well. And it's a good afternoon to you as well, Andrew.
Hi there, Paul. Yeah, I think we've got some really interesting stories to tell this month. I want to cover those in Ghana and Ireland a bit later on. But first of all, I noticed that the gap between our prices data in the Eurozone and US has really widened in recent months. So I'd like to speak a bit about that first. And I know you've really enjoyed some of the stats that people have brought to the table over the years. Today, I've got one on manufacturing input costs. So the prices that manufacturers are paying for the items that they're purchasing. And so what we've seen recently is that we've had a record gap between the input costs index in the manufacturing sector between the Eurozone and the US. So in April, differential hit a new record. In May, it actually widened further and hit a new record again. I'm sure you can see where I'm leading up to with June here. We actually had, for the third month running, a record gap between the manufacturing input cost index in Eurozone and US. So what we're seeing is that in the US, input costs are rising at the fastest pace in about 3 years or so, whereas in the Eurozone, they're actually falling. So really marked different trends going on there at the moment.
Yeah, I think you really set the scene straight away there, Andrew. So I guess a couple of things immediately spring to mind, Tony, when we're kind of thinking about what could be driving those price differentials. I think one is obviously tariffs, which I think some might say has been quite hard to keep up with what has been an evolving landscape. But for products like, I think, steel and aluminium, if we kind of focus on things like that, they've been subject to like 50% import levies into the US since early June. That's actually double the rate that was set in March. But then also, I think you could add into the mix here the weakness of the US dollar, right, on global currency markets. I think we're always wary when we're recording these podcasts that obviously currencies fluctuate kind of on a daily basis. But just looking at the dollar against a basket of other kind of major world currencies, it's been trading around about 10% lower since the end of 2024, which actually I think marks its worst start to a year since 1973. So significant changes in the US dollar. Obviously, on the flip side here, when we're thinking about the Eurozone, the euro has actually appreciated approximately 13% against the US dollar. So being from close to kind of near parity on the 1st of January, the euro is actually now trading around about $1.17.
Yeah, Paul, you're right. The stronger euro is definitely a factor in keeping input prices coming down in the Eurozone. As the author of the PMI for Germany, I'm seeing that coming through in the anecdotal to evidence in the last couple of months. So just a bit of context, I'm sure many of your listeners are aware of how the PMI surveys work. Just for any of those who are perhaps new to the PMI surveys, when businesses fill out the questionnaire each month, they not only are asked to report on changes in things such as output and employment, but we ask them to state the reasons why these things have changed. So we can actually quantify using our panel comment tracker that looks at the frequency of comments over time and it compares it to the long run average. In the case of exchange rates, the impact of exchange rates leading to a decline in input costs is actually running at 4.5 times the long run average in the Eurozone in June. So yeah, clear and obvious that the strong euro is definitely having an impact.
Yeah, it's something I also picked up when I was kind of authoring the Spanish reports as well this month. On the manufacturing side, I should be a little bit more specific there. They were also reporting a strong euro being one of the factors behind driving their input prices down for a second month running. I guess you kind of think a strong euro, that's going to have a negative impact on exports, right? I mean, in Spain, I saw manufacturing exports down for a fifth successive month. Although I kind of get the sense that kind of the general uncertainty of US tariff policy was also kind of a factor in driving exports down. Is that something else that you might have observed, Phil?
It's actually interesting because it's not all doom and gloom in terms of the export picture. So for the Eurozone as a whole, the manufacturing export orders actually stabilized in June, which ended quite a protracted run of decline. Now, a lot of that has to do with what's going on in Germany, actually. So in Germany, we had 3 successive months of growth in manufacturing new export orders, with momentum actually picking up. So June saw the strongest growth since early 2022 on that front. So that's despite what we're seeing in terms of a headwind on the currency front. Underlying data suggested that the upturn in Germany was led by machinery and equipment, and autos having a contribution too. Reports from our panelists indicated a pickup in demand across several markets. There was mentions of increased sales in China, in parts of Europe, so UK, Eastern Europe, and also mentions of stronger demand in the US, where we're seeing companies stockpiling ahead of potential tariff increases.
Yeah, I think that's pretty interesting just on that purchasing theme, isn't it? Because I think, looking at the US data that we have and the reports that we've written there, what remains pretty apparent at the moment is the continuation of that kind of recent trend in June, that is, of the pre-purchasing of goods due to expectations the prices will rise in the coming months. And that's, of course, largely driven kind of by kind of tariff expectations. The buying of inputs, effectively kind of raw materials or semi-manufactured goods in June was actually the steepest we've seen in over 3 years, with firms really trying to look to add to their inventories. Back in May, we actually saw a record increase in those stocks of inputs at US manufacturers. And then we had some, similarly strong growth, not quite as strong as we saw in May, but again, quite a significant increase in purchases in June. But I think just maybe putting aside that kind of current kind of predicament that manufacturers are finding themselves in, I always think that's what's really interesting here, for users of the PMI data is that, as we've noted already, our respondents do provide that written evidence of what's caused a change in a particular variable. And this just really offers some great insight into kind of the behavioral responses to, maybe a change in inflation expectations or something like that. Higher prices are expected due to tariffs, which leads to an increase in buying activity now to avoid price rises later down the track. Of course, in this instance, we may also be kind of trying to mitigate potential supply disruption or general availability of them inputs. So I think it's quite rare with economic statistics to be able to say with reassurance and confidence, the factors that are actually driving those changes in the indexes that we track.
Yeah, that's really interesting on that. And I'd just like to add something, I guess, on that theme of how inflation expectations can impact buying decisions, just by sort of focusing what's been going on in Ghana the last couple of months, because I think it's been really interesting, some of the trends there. But just to give a bit of background, the Ghanaian economy has previously been through a period of quite high inflation, but then recent months, we saw quite a sharp appreciation of their currency. So between mid-April and the start of June, the Ghanaian cedi appreciated by just over 30% against the US dollar. So really quite a large appreciation.
That's a significant change, Andrew, isn't it? We don't usually see that kind of movement in currencies that big. I mean, what's the drivers of that?
Yeah, it's such a sharp thing over such a short period of time as well. I guess, as you guys have mentioned, the dollar has lost some ground over the course of this year, but not to the extent where you'd see a sort of a 30% appreciation. There are a range of factors at play here. Just a couple of them, for example, Ghana's going through an IMF program at the moment, so that's moving along successfully. And then there's restrictive monetary policy as well. So the Bank of Ghana's raised interest rates up to 28%. That's, I guess, helps to sort of bring a bit more confidence around the currency and investor confidence as well. And so what impact this has had really on prices is they're now actually falling. So if you look at our survey, both input costs and output prices have fallen for 2 months in a row now, after having risen pretty sharply previously. And that had a really positive effect on sort of the demand and the growth in the economy, particularly in May, where we saw output and new orders rise at the sharpest rates in 7 years. And we actually had the largest increase in employment since the survey began just over a decade ago, back in 2014. Now, what's been really interesting about the June data is that even though prices have continued to fall and actually fell at a faster pace June than they did in May, we've seen some easing off in growth rates of output and new orders. And what the companies have been saying, I know you guys have highlighted the importance of the anecdotal evidence. This is where it's really important, really crucial, and really helpful in helping us to understand what's going on with the data. Some of the companies have been saying to us that their clients are actually holding off on making purchases because they've seen what's happened with the appreciation of the currency, and they're actually expecting further reductions in prices in the months ahead. So what they're doing is they're holding off and waiting for those discounts to come through again. So yeah, a really interesting look at how inflation expectations, or in this case, deflation expectations, can affect demand and purchasing.
And essentially the kind of the polar opposite there, isn't it, to what's happened in the US? And I think just highlighting those kind of real time effects really of currency and other factors there on behavior. I guess we spent some time out, haven't we, today already kind of talking about what's currently happening with prices, currencies, and how firms might be adapting their behavior to these trends. But I think it would be good now to maybe to switch focus and think a little bit more about what could happen in the coming months. And I guess either by a stroke of luck or perhaps maybe some good planning on our part, we actually have in recent days released our latest business outlook survey, which is a kind of survey of roughly 12,000 of our PMI panelists around the world, where we just ask our respondents to provide us with their expectations. The monthly PMIs are predominantly about what's happening now, what's actually happened in a bunch of kind of metrics like output, new orders, prices, etc. Here on this part of our survey, we're actually asking their expectations across a variety of those metrics. So what people are expecting to see in terms of their activity, their profits, their investment over the coming 12 months. But I thought what would be good just to dig into as a special question we actually asked those panelists around tariffs, which as we kind of noted is a subject that's quite hard to get away from at the moment. Basically, in a nutshell, we asked our panelists what they felt were the impacts of US tariff policy on their business in both the near and the long term. So by near term, we mean kind of the next 12 months. By the longer term, we mean beyond 12 months.
We had some really great engagement on these questions, Paul, from Germany being an outwardly facing economy, exposed to impacts on global trade. So I said lots of great feedback. In terms of the short term impacts, a loss of sales in the US was one that came out quite a lot. That's related to the tariffs themselves, but of course to the heightened uncertainty that comes with it. Clients potentially reining in spending and adopting a sort of wait and see attitude to their spending. And also in the short term, concerns around price pressures too, and the impact on costs, and then potentially having to pass those on to customers. And looking further down the line, the impacts we classify maybe as more structural. So lots of mentions of companies having to localize supply chains, so bringing supply chains back to Europe, looking for alternative markets to the US as well, so selling to new markets that they maybe haven't entered into before, expanding in markets outside of the US, and in some cases even sort of relocation of production to the US in order to service that market and avoid those tariffs.
Yeah, it's really interesting hearing you talk about sort of business locations and potential relocations there, Phil. It kind of makes me think of Ireland, which has really benefited from huge investment into their economy from US companies over the years. Lots of those big companies with European headquarters, for example, in Ireland. And actually the business outlook there was really interesting. So sentiment actually in Ireland fell more than any of the other countries we cover. And confidence now really is at a level that's comparable with what we saw around the time of the bailout in autumn 2010, the time of the COVID pandemic, and then that post-COVID inflation spike as well. So really quite subdued confidence there among Irish companies. And they also actually revised up their expectations for non-staff input costs, and we're only one of two economies we covered to do that. So yeah, definitely lots of, I guess, uncertainty, as you mentioned, and maybe a bit of concern really about what the policies in the US mean for the Irish economy going forward.
Yeah, I think just bringing it back to the US and US companies, expectations there are also quite subdued, but there is a reasonable divergence, I think, between manufacturers and service providers. The latter being much less confident than goods producers when thinking about future activity, and I kind of partly put that down to what some manufacturers perhaps see as the raison d'etre for US tariffs, which is something that you guys have kind of already touched upon from the perspective of from Germany and Ireland here, is that US companies kind of see the potential for a stimulation of kind of domestic-led industrial growth, driven by reshoring of operations or, demand from within America kind of returning. That said, there's similar kind of worries as well, of course, in the US. There's similar concerns about short-term price increases, which are broadly anticipated. And I think most notably, US firms are expecting to raise their prices to the greatest degree since October 2022, which I think, if that actually feeds through to kind of a general increase in consumer price inflation, that's going to cause a significant headache for the Federal Reserve. I think just, my final point on the US, because it's so topical, I think, given the current news flow, it's just the hard-to-read nature here of trade policies and tariffs. Firms are trying to roll with it, but they're experiencing a profound uncertainty, and it's really complicating kind of their investment decisions, their purchasing strategies, and operational planning at the moment.
Yeah, and that sort of the impact of that general uncertainty can really be seen across the global outlook data, I think. So if you look at plans around capital expenditure and R&D investment, those are both still really subdued. And actually, on the other side of it as well, employment. So employment expectations were the joint lowest since the pandemic in June, unchanged from where they were in February. So yeah, as you mentioned, that general uncertainty is really quite clear, I think, at the global level. Firms taking that wait and see approach and just looking to hold off on investment plans for now.
Yeah, it's certainly the case in Germany too. We're seeing a subdued investment picture, you could say. That said, the direction of travel in Germany is positive, actually. So for the first time in 2 years, German businesses have signaled their intention to actually increase investment. So although the net balances are only mildly positive, they are at least positive for the first time in 2 years. So it seems to reflect growing confidence in the economy, which is strongly linked to this new investment that's coming from the new German government. So a big spending package in infrastructure and in defense spending, which is expected to lead to a broader economic upturn and then spill over to other areas of the economy. Well, if I can bring it back to the inflation story, the inflation outlook in Germany, it looks okay. Businesses aren't expecting a spike in inflation according to the outlook data. But of course, if this extra government stimulus does happen to meet some supply bottlenecks down the road, then that potentially could lead to some inflation. And it's obviously something PMI data will highlight in the months and possibly years ahead.
I think that's a great point to finish on, really. We have the tariffs, which are causing a kind of a common impact in a kind of international, globalized sense, but equally we have those specific domestic considerations as well here to think about, which of course the PMI data and the responses from our firms are picking up, from them currency effects we've seen in Ghana, to fiscal stimulus packages in Germany. So like I say, I think that hopefully just shows the additional value and insight that our data and information and various anecdotal evidence gathering really brings to our users and listeners here. So sadly, I think that's all we've got time for today. It's time for us to slide away, so to speak. So my thanks to both Andrew and Phil for your insights. And we'll be back here on the Decisive Podcast after our summer break. So for now, it's a goodbye from us. And we look forward to catching up and discussing the very latest PMI data insights later in the year.
Thank you for listening to the Decisive Podcast from S&P Global. Please subscribe and join us for next week's episode. Until then, stay curious and stay informed.